All right, it's time now for our Muni moment. Negative headlines plaguing cities like San Francisco, and Muni investors are finding that demand is so robust that it isn't being reflected in spreads. Let's get some insights out of our next guest. Kim Friedricks joining us right now, Managing Director of Fixed Income over at Kayne Anderson Rudnick. And it was interesting, someone put this across my desk here, because we hear all this gloom and doom about San Francisco, and I guess you can throw New York, Chicago, and some other big municipalities in there. But you're saying that, well, maybe municipal investors don't seem to mind that? Why not?
You're just not seeing it. What you're basically seeing is that there's very little supply out there, and there is so much demand right now that we're seeing just, there's $5 billion have gone into Muni ETFs just this year, and you're just seeing demand, particularly in high-priced, high-tax states, just pushing demand so high that they're not concerned. So what you see is something like an LA MTA is pricing exactly where it should be, in line with a San Francisco BART, a San Francisco BATA. Everything's just in line, and we're seeing just tight spreads, and they haven't moved. BART and BATA have both been downgraded due to what's happening in San Francisco, but we're not seeing that moving into spreads at all.
I am curious that when we talk about some of the issues themselves here, are investors sort of parsing the difference in those issues, meaning like something just sort of like a general obligation type debt versus something that's maybe very specific to, like, I don't know, a toll road or a specific project?
Well, I think there's some of that, and most of these transit issues or some of these different issues have a difference between what we call butts in seats versus sales tax revenues, that type of thing. But even sales tax revenues are being impacted in some places. So you have to look at it, but there's a lot of depths of revenue. Where can we go for different tax sources, that type of things, and what times coverage, like how many levels of coverage do we have before we're going to get into real trouble paying for these bonds? But you are seeing downgrades. So the rating agencies are being concerned, but investors are looking at it and saying, I need bonds, and there just aren't that many bonds out there.
That's what I wanted to get to, whether sort of these dynamics that we're talking about are translating into ratings. But just crystallize that point for me. So the ratings agencies, they are acting here, they are downgrading, but the actual bond buyers maybe are brushing that off?
Exactly. It's a matter of supply and demand on some levels. I mean, there's just not enough supply, tremendous demand, and a lot of money going into ETFs, which simply, to be quite honest, just have to buy bonds. So they're just out there buying bonds, and they're not necessarily as concerned as maybe an individual investor might be.
And
but go ahead.
No, you go on.
No, I think that's part of it. Individual investors might be being a little more picky. So people invested in SMAs might be seeing, a little more selection criteria there. But right now there's very little supply, particularly in high tax states where people are very, very, there's a huge amount of demand for tax-free income.
And Kim, we've been talking about low supply in the muni market for a while now, at least several months here. And you think about this big uptick that we're starting to see in corporate issuance. Is that a sign of things to come in the muni market, or would you expect supply to remain depressed here?
I don't really see supply starting to roll out in the muni market. We have, coffers got filled during the pandemic. What we're seeing is, rates are higher now. Debt got refinanced when rates were low. If I'm a city manager looking at my situation, I've kind of gotten my reserves back in place. I've lowered my debt costs. I'm not necessarily looking at needing to go out and do something right now in a higher cost environment, and I don't need to refinance my existing debt. So with the exception of a few select projects here and there, I'm not seeing this as a time we're going to see a huge amount of new issuance.
That's interesting. When we get maybe a little bit deeper into next year, and maybe economic conditions change, or more importantly, the funding needs of some of these municipalities change, how much of a potential uptick could there potentially be?
Well, when things start to change, if interest rates start to change, if you see Project needs can change dramatically. We can have natural disasters that cause them. We can have, just about anything can change in local situations that change those needs. But if you refinanced your debt to lower cost debt along the way, having needs to refinance are going to be few and far between, which has been a big driver for new issuance over, most of the last decade.